Okay, I'm very excited to be talking with Ken French, who is the Roth Family Distinguished Professor of Finance at the Tuck School of Business that's at Dartmouth. He's also a director of the Dimensional Fund Advisors, which is based in Austin, Texas. But today, Ken, I want to talk to you about portfolio design and really try to understand that if someone wants to develop the most perfect portfolio, what should he do?
The short answer is they should try to figure out how they differ from the average investor. Start with a market portfolio and adjust it for whatever differences they have relative to the average investor.
What does a difference mean?
What I have in mind when I say difference is perhaps somebody's particularly risk averse. The market portfolio that I have in mind, normally people think what you mean by the market is the stock market. What I mean is all financial assets out there. And what I know is the average dollar invested has to hold that broad market portfolio. And the argument is easy. There's no shares laying around in the gutter. There's no bonds stacked on roadsides that nobody's owning. Somebody owns everything.
Mm-hmm.
So if I aggregate everybody's portfolio, it must be the aggregate of everything. That tells me that the average dollar has to look like a pro rata slice of everything.
When you say everything, everything is kind of a big picture. We've got stocks, bonds, but there's more. There's real estate, there's commodities, there's so much out there. Is that what you mean by everything?
That's exactly what I mean. What I mean, to be precise, is everything that's in positive net supply. And to be clear, for example, a futures contract, every long, there's somebody on the other side of that contract. You can think of it as just a bet. We don't want those side bets in our market portfolio because they just aren't there if I aggregate everybody up. Options, swaps, anything sort of derivatives where there's a long and a short, those aren't there. But all other financial assets, that's what I have in my mind when I say a market portfolio.
And is someone supposed to try to figure out what the overall allocation is in the world and then make his portfolio look the same way?
Nah, that's too hard.
Okay.
I think it's pretty easy to just say, ballpark, here's a reasonable portfolio. And really what it's doing when I say start with the market and then figure out how you're different, it leads you a totally different path than if you were saying, well, what's the best mutual fund manager out there? Or which hedge fund should I try to hire? It's a top-down rather than that sort of bottom-up. Which stock should I buy? Or which bonds should I buy? That's the bottom-up approach. And what I'm arguing is you want exactly the opposite. Almost all investors out there really should be saying, boy, that's a market portfolio. How do I differ from the average investor? Maybe I ought to shift my portfolio in that direction.
Well, it sounds to me like you're saying that you want to invest in simply the growth of the world. You're saying we're here today, tomorrow it's probably going to be better. Let's just get our money invested in it. I don't know where it's going to be, so I can't hire some manager, or we're in Israel here, we try to hire prophets. I'm not able to do that. So I just want to go in the direction of the economy of the world. Is that a fair way to describe what you're saying?
I actually never think of it in my head as I'm buying the economy of the world, but you can if you want. That just presumes that the return's coming from the growth of the economy. But it could be the economy shrinks this year. But if that shrinkage was anticipated, I should still get a positive return. So I never conflate the growth of the economy with the growth of security returns or security prices.
Well, we all know that the markets go up and down over time, and some years the whole world market doesn't look so stellar. So it has to be, presumably, the model you're describing, which, as I'm saying, is invest in the whole world growth, would have to be a long-term portfolio, no?
Even if I were going to do this for the next year, I would have the same mindset. It basically, you're right, it's not something that somebody who wants to trade every hour would have any sense in doing. But in my mind, somebody who's trying to trade every hour, almost everybody who's doing that is just sacrificing money. So it's founded on this notion that it's a notion that Bill Sharp wrote a paper about back in, I think it was published in 1991, Financial Analyst Journal, that the average dollar invested actively has to lose relative to the average dollar invested passively. And it just comes down to cost. If I have passive investors holding the market portfolio, the aggregate of everybody else has to be the market portfolio. It's that same adding up constraint that I was talking about earlier. If I take my pro rata slice of every asset in the world, what's left over? Every asset in the world in exactly the same proportions that it used to be. If I take a thimble of blue paint out of a bucket, I still have a bucket of blue paint. So I know what my return is going to be. It's going to be the return on the market minus my costs. And I also know what the aggregate of everybody else's return is going to be. It's the return on the market minus their costs. They're out there doing active, they're trading more, they're paying their managers more. All of that creates more costs than my passive market strategy. So I know my return on the market minus my lower cost, is going to be higher than their return, the return on the market minus their higher costs. And that's not a statement that it's a long-run phenomenon. It certainly is a long-run phenomenon, but it literally happens every instant. I know every instant I'm beating the value-weight average of everybody else.
We're talking with Professor Ken French. He's at Dartmouth College in the Tuck School of Business. He's also a director and a consultant to the Dimensional Fund Advisors based in Austin, Texas. Ken travels around the world doing a lot of talking. And Ken, you've been describing to us this concept of investing perhaps in the whole world and looking at the fees, understanding quite clearly that if people are taking money off the top, whether it's to pay managers or to pay trading costs, that's obviously going to eat into the return of the investor. Let's talk for the next couple of minutes about practically someone who wants to use this model of investing in the world, who actually has specific goals in mind, like saving for retirement or saving for a kid's college education. How can that person translate what you're saying into a real nuts and bolts investment decision?
Basically, what you're saying is, okay, I have somebody who might be different from the average investor out there. They're saving for college. In that sense, they have at least some commitment with a shorter time horizon that somebody else might have. And they might want to adjust their portfolio. Maybe they want to do a ladder strategy on bonds that basically delivers the cash flows that they're going to need when their kid retires. And they might be accumulating that over their child's youth till the kid's 18 or 20 or whatever. But the whole framework here is the reason you're not buying a broad market portfolio at that point is because you're different. You have a particular liability that you're trying to, quote, immunize, that you're trying to lock in here. And you would do that over a period of years with a specific eye to saying, okay, these are the cash flows I'm going to need in the future, and let me build that portfolio. But you wouldn't be buying bonds out there because you thought they were underpriced. That's the key. You'd be buying those bonds because you had specific cash flows in the future that you were trying to basically hedge today with your investment strategy.
Let me try to translate that into the way that I normally describe it. My day job is that I'm a financial advisor, so I sit with people and I talk to them about what their goals are, like sending their kids to college, and then we try to develop an asset allocation model that makes sense. It sounds to me, and I just want to make sure that what you're saying is what I say to people also, is you need to understand specifically what your goals are, and then, depending on what they are, take parts of your portfolio or your whole portfolio and design it so that it is built to achieve your goals in the most efficient way possible.
Absolutely, Doug, you've nailed it.
Okay.
And the key there was that last statement, in the most efficient way possible. And for almost all investors, the most efficient way possible is not out there trying to beat the market. It's trying to get the best investment experience by choosing a passive strategy, deviating from the market only because of the sort of arguments you've made.
Well, that presumes that the market, the fear that people have because they're silly enough to actually listen to the media is that things are going badly. And they say, I better get out because whatever. There's always something bad in the news. That's what the news likes to sell. And I think we all know that people who invest without the benefit of the news do better than people who actually follow the news. But nonetheless, the average guy in the street reads the average newspaper and is frequently afraid. And then you're saying, yeah, but invest in the market. And he goes, yeah, I would. But, we all know the market's about to go down. I think that's where people really get stuck. Don't you find that?
Absolutely. I mean, the fact that somebody thinks we all know the market's going to go down, you just got to ask, why isn't it already in the price?
Mm-hmm.
And it may be that the market will go down. Now, what I always say is I'm sure the market is wrong. I just don't know which way. And a good example of this is in the middle of the financial crisis, clients who wanted to move out of the market because they just had no idea prices could go down the way they did it during the financial crisis. My view was, okay, if that's what you want to do, that's totally fine. If the reason you want to do it is either you've learned markets can be more volatile than you expected, or your level of risk aversion is higher than you thought. Either way, fine. You were in the wrong portfolio to start with, but now that you've made this adjustment, you should plan to hold that portfolio from here on out. You've learned something either about yourself or the world, and you ought to adjust your portfolio to reflect it, but you shouldn't plan to come back in the market later.
I think that's a great place for us to end today, not because I don't have many more questions, but because we're out of time. Ken, in the last few seconds, just tell us, how can people follow you and follow your work?
I have a website that people use because what I do is provide literally hundreds of return series on my website. And if you just Google my name, Ken French, particularly if you say Ken French Data, that will show up. And then my co-author, Gene Fama, and I have what we call the Fama French Forum. It's just famafrenchforum.com, in which we sporadically post things that we're interested in, things that we've written, paragraphs, papers, whatever. Some people might find that interesting.
Okay, we will put links to that at the show notes of today's show. Ken French, thanks so much for taking the time.
Thank you, Doug. I appreciate it.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.